Right now, and you can see that the Fed interest rate target there is the blue line, and the PCE index for inflation that the Fed follows is the white line. And since the Fed has began cutting back in September, inflation's actually risen. So you can see an argument for not doing what the president wants today, even if the economy is slowing. And we'll see what Mr. Powell makes of it all this afternoon. Decision at 2 p.m. and the press conference at 2:30 p.m. Wall Street time.
Looking forward to that decision and that coverage. Michael, we'll see you there when John and Tom get back together for the Fed Decides. Joining us now is former Goldman Sachs partner and current Columbia Business School professor Abby Joseph Cohen. It's great to have you on the program. Really appreciate your time. Let me first ask your take on what the Fed should do here. We were talking with Jay Hatfield of Infrastructure Capital Partners. He said he thinks the Fed needs to be at 3% rather than 4.5% because these high mortgage rates are hurting the economy. What's your take?
There are several things hurting the housing market. It's not just interest rates. Supply is a big issue as well. So to go back to your question, I think this is a Fed that most likely will decide to stay put and wait for the new data to come in. We are at an important point of inflection. It's certainly true that real final sales have been moving somewhat lower. We also see that inflation-adjusted capital spending has been moving lower, not recessionary, but slower growth in these categories. I think the real test, however, comes in the second half of the year. So far, economic data top line has been extraordinarily noisy because all of the erratic discussion about what the new tariff policies will be. As we have more and more structure around that, I think companies can finally decide how much of the tariffs they're going to absorb, how much they'll pass on to consumers. And consumers thus far have shown some reluctance and some hesitancy. I'm watching those consumer spending numbers, but also what are businesses doing with regard to their new investment in capital equipment. And if that continues to slow in the second half of the year, that may be the point at which the Fed decides to step in.
So far this earnings season, you've seen many companies shrug off the impact of tariffs or report kind of marginal hits. Now, you note that the effective tariff rate might be much higher than people came into the year expecting and higher than what a lot of Wall Street came into even this quarter expecting. Around the mid-teens, could get closer and closer to 20%. At what point does that make a real difference, Abby?
Sonali, great question, because it has been an expectations game thus far. Following the comments that were made by the White House in April, people are saying, whoa, 15 to 18%, not so bad. But let's put that in context. These are Smoot-Hawley level tariffs. And again, some of our most important trade partners, including Canada and Mexico, the numbers could be even higher. And so I am concerned that these are things that will be disruptive. Up to this point, many companies have, in fact, decided to absorb those tariffs. Some of that has been the the companies outside the United States, some U.S. companies. But let's take a look at the most recent discussion, particularly in second half guidance, as companies here have reported their second quarter results. And we see companies like Procter & Gamble and Hershey and some of the pharmaceutical companies basically saying they're not going to be able to continue to absorb tariffs if they stay at the levels that are now suggested. But what we, of course, know is that those tariffs have been a moving target, and they are being imposed in slow motion. And so I don't think we can assume that the data we have seen thus far tells us how companies will respond in the next few quarters.
Yeah, no, I'm seeing multi-billion-dollar hits at companies. Obviously, I follow the car industry very closely. But, Abby, we have a great screen on the Bloomberg that is fairly complicated, but it shows the effective tariff rate for each country with which we trade. I think it's incredible data. And The one point I will make is when you look at these numbers, very high, obviously China's up there at almost 50%. Mexico and Canada lower. Mexico at 4.3%, Canada at only 1.9%. But that's because this is calculated on total duties collected and the customs value of imports. So when you have these tariffs set fairly high, Abby, companies just don't import as much of that stuff, right? So you get a lower effective rate. How much do you expect it to add to inflation once they stop, eating these costs in their margins or getting suppliers to give them a break?
Sure. Well, let's back up a little bit. I can answer your question very simply and say that people who've done the analysis believe that at the tariffs that have been announced thus far, we're talking about an increase in top-line inflation of about 0.4%, which is not insignificant. But I think we make a mistake if we think it is a simple calculation. So, for example, Matt, you're so familiar with the auto industry. You know full well that a car that is manufactured, i.e. assembled in the United States, so much of the input and the parts that go into that vehicle are in fact coming from Canada, and in some cases Mexico. And so if we put a significant tariff on Canada, that in fact raises the price of what we view as domestic vehicles. And by the way, it's also input tariffs, for example, steel and other components.
Abby, I also want to get your view here on what's happening on a stock-by-stock basis, because I've seen you recently say you're taking a look at CyberArk software. And interestingly enough, this morning we were out with a deal from Palo Alto Networks making an acquisition offer here. What role is M&A going to play in this market? And ultimately, what does it mean for investors?
The recommendation for CyberArk was done in January, and it was based on the idea that that was one company, for example, that offered some good idiosyncratic opportunity. The overall market is not inexpensive at this point. In fact, one could argue, based upon several measures, it is testing some valuation limits. However, you are right. I think that M&A activity will be significant. Keep in mind that many U.S. companies are very cash rich at this point, and they will be looking for strategic opportunities, that is, ways to enhance their own competitive stature. And I do think that there will be a pickup in M&A, and it won't be limited to technology. I believe that we will be seeing it in many different categories of the U.S. market. And the thing that is a little bit confusing right now are those cross-border transactions. Obviously, with changes happening more rapidly than we are accustomed to with regard to foreign exchange, that is something that may complicate things. Also, we need to look at the regulatory structure, whether the administration here will approve some of these cross-border transactions.
Abby, never enough time with you. Really appreciate you joining us this morning. Abby Joseph Cohen there from Columbia Business School.
And the point that Abby was making about the valuations by some metrics looking toppy, it's good if you're selling a company, right? You're getting top dollar for it. And of course, we're watching some IPOs this week and some single stocks.
I will also say the point about parts, well taken, right? There are almost no parts in a car assembled in America that don't have some a piece of them from overseas, right? Even if you have a part that's put together here, it's usually made with aluminum from Canada, for example. So
I think it also matters where it comes from, to the point that you were making on. That screen is just incredible. Would have everybody look out for it, because from India, for example, what you're bringing in is electrical manufacturing, you're bringing chemicals in, so it does impact the supply chain. But speaking of supply chains, we're watching here somebody trying to expand theirs, that it's Starbucks shares extending their decline because the coffee giant's sales and profit fell more than anticipated. This was interesting. I know you guys were looking at it this morning too.
Well, this morning it was up 5% and in the pre-market. Now it's down 3%.
Foamy
I guess
coffee or something
investors
like that?
just aren't as pumped about cold foam protein as Michael Halen. Vans and North Face owner VF Corp surging as a brand revamp begins to pay off. Huge gains there, 12%, 11%, and Have you seen Fast Times at Ridgemont High?
No. Should I be?
You should definitely watch it. That's what made Vans slip-on shoes so famous.
Oh,
the
very
Coley wears
interesting.
those black and white checkered slip-on shoes.
Well, also, retro is just back in style these days, too. I think this one's interesting. Speaking of things flipping around, Visa was lower earlier this morning, but it left its full-year outlook unchanged. Investors now latching onto the story a little better, and now it's up about 0.9%.
All right, coming up, KKR is riding high on a new financing deal with Harley-Davidson and actually a whole fund dedicated to these asset-backed assets.
Hogs are rising.
Does that make sense? Asset-backed assets? Yes, it
Asset-backed
actually does.
finance.
We're going to talk to Daniel Peterzak, KKR's global head of private credit. When we come back, this is Open Interest. Let's get to high interest now. A look at what's making headlines around the world. President Trump says he will impose a 25% tariff on India starting this Friday. The president also suggested he would add an additional penalty over the country's energy purchases from Russia. The levies crush India's hopes of preferential treatment over its Asian peers. India was among the first to engage Washington in tariff talks. Shares of Palo Alto Networks are slumping after the security company announced a pricey deal. It will buy CyberArk software in a cash and stock deal that values the Israeli cybersecurity company at about $25 billion. That's a 26% premium to the average share price. This transaction expected to close in the second half of next year. And Harley-Davidson announcing it struck a deal to monetize its financial services division. It's been a rough ride for the iconic motorcycle maker. It saw sales decline in its latest quarter thanks to slowing bike demand and economic headwinds, high rates, and tariffs. didn't stop me from actually buying one. Sonali.
Matt, how much is a hog to buy again?
Well, if you buy, like, the most popular bikes are the Lowrider and the Lowrider ST. This is Heritage that I'm riding here in this video, but those are like $20,000 to $24,000. So for a motorcycle, that's a pretty high price tag, and so most of the people who buy those motorcycles finance them.
Really expensive. That is a good note to bring in our next guest. We're going to take a deeper dive into Harley-Davidson's deal on today's Wall Street Beat. The iconic motorcycle company is confirming that its financial service unit is selling an interest to KKR and PIMCO and selling a loan book of over $5 billion to those credit firms. Joining us now, Daniel Peterzak, Global Head of Private Credit at KKR, who helped secure the transaction here. KKR has separately said this morning that it has raised $6.5 billion for asset-based finance, the largest credit fundraiser to date. And the fund, including its separately managed accounts, is roughly twice the predecessor fund. I believe this is the fund that the Harley deal came out of. Dan, thanks for joining us here on set. How did you get to this deal?
No, and thank you for having me, number one. I think our asset-based finance business has been a big focus of ours, right? We've got a large-sized private credit business, about $117 billion of AUM. The asset-backed business is 75 of that. We believe there's a very large thematic out there with these, portfolios of, financial and hard assets. Investor interest, as you know, has been high in private credit, but people have been looking for diversification. So, I think that was the tailwind of the fund. I think we were very happy with that fundraise. But, we look to partner with companies like Harley. I mean, such an iconic brand. I think there has been a pretty strong thematic out there, and the equity markets have probably been insisting on it, about companies becoming more asset light, moving from that balance sheet heavy to that asset light. We've done other transactions like this. I think we've talked to you about PayPal. But I mean, I find us very lucky to be able to partner with a brand like Harley against a very good sort of consumer loan portfolio.
I also obviously am a huge fan of Harley-Davidson motorcycles. Maybe I'll borrow some money from you to buy my next one. Does the path of rates matter to you in making a deal like this? Do you want to be making deals like this as the Fed is in a cutting cycle? Well,
I probably put it in two ways, right? I think if we think about the credit risk of the underlying, we have focused probably on the higher FICO consumer with most of the activities we've been in. The buyer base is a higher FICO consumer here on average. So I think that's kind of helpful. In the business itself, though, we're trying to neutralize rates, right? So if we buy fixed rate loans, we try to issue fixed rate debt. If it's floating rate loans, try to match that with sort of floating rate debt. So we try to take the rate element out of that. I think you could argue that a lowering of rates would be beneficial to the economy, good to the pasture of the end consumer. So probably not a bad fact.
Dan, I am pretty fascinated by how much you have focused on consumer-driven sectors. You had that student loan portfolio acquisition alongside Carlyle from Discover. You mentioned PayPal, buy now, pay later loans. Are you not worried about the consumer, given all the concerns around tariffs and where interest rates have been? Yeah,
I would say we're definitely mindful about it, right? And I think, a couple of points. One, our business in the asset-backed side is across sort of all asset classes. So my guess is any individual fund, the consumer kind of portion is probably 25 or 30%. Maybe the resi mortgage portion is, about the same size, but that's secured. That is different. I think on the consumer side, we have tried to target either that higher FICO piece that I mentioned, or secured risk like auto loans, like we're talking about sort of here with Harley. So I think we're trying to position that. But the whole thesis of our business has been across asset classes, right? We've got a big footprint in aviation leasing and other forms of commercial finance. It is global in nature. So I think we're trying to build diversification in the fund.
When you look at the consumer and you look at one big, beautiful bill, do you have a sense of optimism that we're going to see higher after-tax incomes? Because that would obviously help.
Yeah, I mean, again, that probably goes into the tailwind bucket. I would say from the consumer perspective, we've probably seen two things, right? There has been very good performance data on the consumer, specifically as it relates to the loan portfolios we own. But that's probably been a little bit skewed or weighted because we've been at that higher FICO. And I think we've seen that higher FICO probably a little bit less sensitive to inflation, probably, a little bit, more kind of savings along the way.
But Matt made a great point to me just this morning about, okay, so if you're buying a loan book from Harley-Davidson and then you have the protection from the asset, right? The Harley itself, depreciating asset, but an asset nonetheless.
A cool asset.
Depends on who you are. But anyways, I'm scared of motorcycles a little, and we're working on that. But if it's a student loan portfolio, then what are you really backed by? Do you think that the broadening of the base of asset-based finance here leaves
That's true.
you
If Sonali
some
defaults,
room
you can't
here?
take her master's degree.
Right, exactly.
No, and it's a great question. I mean, you're underwriting each of these deals on an entirely sort of bottoms-up basis, right? So if you think about what the key drivers of that would be, it would be what is your forecast of forward defaults, and then what is your forecast of recoveries, right? And clearly in an unsecured loan like a student loan, you would be a little bit more worried about that recovery rate clearly than something that's secured like a Harley sort of loan. Now, that said, I think you also would look at kind of what the borrower base is, right? That Discover portfolio was generally guaranteed by the parents of those students. That average FICO score was even much higher than we're sort of talking about here today. So we do view this business as a business that is intended to provide our investors real downside protection. Right, these are amortizing loan portfolios. These structures delever. And so, we're factoring that into every deal that we're doing, really trying to make sure that in our mind, even in a financial crisis type scenario, we're getting our money back.
I've got to just redeem myself quickly. You do look cool on a Harley, to be clear.
That's so kind of you.
You're welcome. I feel like I took away
That's
from you.
so kind of you. Daniel, you and I have to get out for a ride soon. Daniel Peterzak, there of KKR. He's going to join my gang.
Yeah. It'll
gang.
take me a while.
Still ahead, more on the private credit market. We're going to speak to Jeff Aronson, co-founder of Centerbridge Partners. This is Open Interest.
going to check on these markets because you're looking at an S&P 500 still drifting higher about 0.2%. The NASDAQ 100 up almost 0.3%. And the 10-year, you're seeing the bond market across the curve looking at yields higher for the 10-year. That's almost 5 basis points at 437. On the day, really interesting moves here, Matt. We had strong economic data ahead of that Fed meeting later this afternoon.
Yeah, interesting to see S&P 63.84. We had to be 63.90 to make a new high, but anything could happen when we get to the Fed. Liz Hart joins us next from Newmark. This is Bloomberg. Investors will be awaiting clues on when rate cuts are coming. Fed Chair Jay Powell delivers the decision at 2:30 this afternoon. Let's get a read on how the current rate environment is impacting the commercial real estate industry. Newmark's president of leasing for North America, Liz Hart, joins us here at the desk. Liz, great to have you in the studio.
Thanks for having me.
Tell us, first of all, give us like a temperature check on commercial real estate, because lately when we're talking to investors, reporters on the BN side have been asking us, do they have dry powder for commercial real estate right now?
Well, we'll find out if they have more after today, won't we? But I think what's really interesting is if we go back to what happened after June, it's not just about if we're holding or cutting, but also what is the messaging behind it? All of our tenants, our landlords, they look at that messaging extremely closely to try to figure out what they should do next. And what we saw from a statistical perspective is after the messaging in June, we saw tenants that were looking for growth versus the same go from 40% to almost 50% of the market. That's a pretty significant change in just a couple months over the summer.
So what does this mean for the Fed to lower rates? If they were to lower rates at least once this year, does it really impact the longer end of the curve? Because there's a lot of doubt and skepticism.
That's a good
Although
question.
I did listen to your Jay Hatfield interview a little earlier, and he seems to think that it could be material for the 10-year. How much does
it definitely
matter?
helps improve it, but I think there's also things like the jobs report that's coming out on Friday. There's the big, beautiful bill and all the changes that it made to lease depreciation of tenant improvements. I mean, those sort of things are also really impacting the market right now and how landlords are approaching attracting tenants.
How much of a tailwind is that? And explain the mechanics of what the big, beautiful bill does for commercial real estate.
Absolutely. So we've talked about Trophy before, and Trophy has been, as you know, one of the highest performing asset classes in commercial real estate. But what about?
So what are some examples?
You know all the Trophy buildings, but what we really should talk about is that next category. So the next category of buildings that need renovation, buildings that need tenant improvements, buildings need to improve their positioning. The big, beautiful bill, because of the bonus of depreciation of tenant improvements, helps that. So it should accelerate that second class of assets that really want to be in that top tier, moving that direction. So hopefully they can compete with those higher end buildings that we've been tracking for so long across our core urban markets.
Speaking of urban markets, do you see people looking at lower tax areas anyways, given that adjustment that we're seeing? Of course, in New York here, you have a lot of questions about what it would mean if Mamdani were to become mayor. Also, do you see people moving? They say they might, but then equally we hear just a little bit higher in
Mamdani
taxes.
maybe mayor, and we didn't get the kind of salt relief that a lot of New Yorkers need.
These combinations are certainly factors, but in general, businesses want to go to where the talent is. And so if there's still the biggest concentration in places like San Francisco, New York, those core urban areas, we still see the most growth and demand there, even with the Mamdani news, which has been a couple of months old at this point. So I don't see that changing very dramatically. But, there's other cities like, Dallas, Texas, which has been performing very, very well. And that certainly is partially because of the tax changes we've discussed.
I got to ask you about something maybe a little bit sensitive, and that is we had a shooting, again, a mass shooting, but here in New York in an office building.
Yeah.
And how does that impact the market? What are you hearing about increased security? What needs to be done?
Well, it's a tragedy, right? There's no other word for it than that. And that asset has extremely good security. So I think this isn't about the asset level. This is about policy level changes at the city, state, and federal government, and making sure that we're doing what we need to protect our people on the streets.
What does it mean for employers to bring people back to work? Now, the Blackstone building, they can't go back to work yet. They're still investigating the building itself. They don't plan to have people back in the coming days. But there are employers that brought people back right away. They said people can take time. It's August, so a lot of people are not in New York already. Do people want to
I imagine a lot more people don't want to come back to the office, though. When you hear news like this, you think maybe it's too dangerous.
I think that it's not just happening in office buildings. This issue is happening in retail centers. This is happening on the streets all over America. Again, the office is one place that this can happen, but it's because of that larger, greater policy that's happening across the country. As it relates to return to work, we haven't heard anything.
Larger, greater policy like we shouldn't be giving people with mental health issues guns.
Yeah, exactly. I mean, that's obviously a personal opinion versus a Newmark opinion, but I do agree with that. And I think it's really important for us as a society. As it relates to office, I don't think that we're hearing from people that individual incidents in one building are impacting the overall office market.
Let me just ask one more to get back to the Fed, to get back to rates and the business that you do.
Yeah.
How painful are rates now, and where would you feel more comfortable?
I'm just going to say lower is usually better for commercial real estate.
All right. Liz, great having you in the studio. Thanks so much for joining us. Liz Hart there from Newmark. She runs their North American business. Let's take a look at what the markets are doing ahead of this Fed decision. You typically don't get a ton of trading. You don't get a ton of volume. Traders sit on their hands, maybe turn off the algos and wait for Jay Powell, wait for Tom Keene and John Farrow. We'll have that special for you, 1:30 today, the Fed decides. But we do see gains almost to at least the closing highs that we made on Tuesday.
Yeah, and even the intraday high would bring you above 6,400. So that's a new barometer. It's a new moment, a new round number that markets are going to be looking at. I do think it's interesting, to your point, traders usually sit on their hands. You do see some movement in the bond market still, of course, with that Treasury announcement of the way that they will be repurchasing in the future, bending towards the shorter end of the curve here. Strong economic data. Interesting setup, Matt, for the Fed.
Yeah, we do see volumes lower right now, if I look at today's stock trading versus the 30-day average, we're down about 4.5% at this time on the S&P, about 24% on the Dow Jones Industrial Average. Let's get a look at some of the single stocks moving at this hour. For that, we go to Bloomberg Equities reporter Nora Melinda. Nora?
Well, Matt, I've got my eyes on a couple of those big tech stocks that we were looking at today, especially as we get earnings after the closing bell today. Let's look at shares of Meta and Microsoft this morning. We're seeing both of them pointing higher right now. But as we think about earnings, we're really going to be seeing a lot of investors, Wall Street really focusing on CapEx spend. We're seeing investors really pumping these companies with lots of money. We're seeing both of the companies up about 20% year to date. But really the question here in the scrutiny lies in how much more money they'll be spending toward these AI endeavors. But I also would like to take a look at Starbucks. We're seeing shares down this morning, and that's after the company's sales and profit fell more than anticipated here. We have the CEO, Brian Niccol, who's really come in trying to paint a comeback story here for the company. They're really wanting to cut down on wait times, bring in a menu revamp, and also bring in more seating to these stores here. But analysts are really, while they're behind the ideas that he's proposing, they're really skeptical about the price tag and the timeline of how long it'll take for this to happen. We're seeing shares of the company down about 0.7% year to date. And lastly, looking at Humana shares, we're seeing the stock up this morning, and that's after they raised their full year profit guidance. But this has really been a bright spot, bucking the trend from a lot of these other health insurers that have been reporting. But the idea that their profit guidance looks a little bit hazier than anticipated. We're seeing Humana really saying that most of the revenue is coming from the Medicare Advantage and pharmacy sectors here, as they're a bit more insulated with less exposure to the Affordable Care Act and Medicaid. Shares are down about 3% year to date, Matt.
Nora, we thank you so much for keeping an eye on all of it for us. That is Bloomberg's Nora Melinda. And coming up, another check on the private credit world. We're going to bring in Jeff Aronson. He's co-founder of Centerbridge Partners, and he joins us next. This is Bloomberg Open Interest.
It's Jobs Day, and Bloomberg has the report under surveillance.
It is definitely a stagnant market.
Everybody's looking for a slowdown in job creation.
You're seeing a tightening in parts of the labor market.
This Friday, Jonathan, Lisa, Anne-Marie, and Mike will bring you crucial data and expert analysis at terminal speed.
Jobless claims have just hung in there.
This is a hot report. It's definitely going to be taken with notice and optimism from this administration.
The July Jobs Report, Friday on Bloomberg.
Investor interest, as you know, has been high in private credit, but people have been looking for diversification. I think there has been a pretty strong thematic out there, and the equity markets have probably been insisting on it, about companies becoming more asset light, moving from that balance sheet heavy to that asset light.
That was KKR's Dan Peterzak telling us about the trends in private credit that influenced his firm's $6.5 billion splurge, bringing in money for asset-backed finance deals, diversification in the private credit world, which brings us to our next guest, Jeff Aronson, co-founder of Centerbridge Partners. And a really interesting moment, because it used to be that when people spoke about private credit, it was that 1.7 trillion direct lending pie. But they're looking beyond that now, and I'm wondering how much that's because investors are looking for safety. They're looking for protection in this market.
Yeah, I think investors like private credit because it offers safety. You're not going to lose your money, and a really good return. So people like that combination. But private credit, if you step back about it, think about it, it's an asset class. People always ask, what is it? It's an asset class with lots of strategies within it. So what Dan is doing in terms of asset-based finance, or direct lending, or opportunistic credit, or infra credit. So there are a lot of different flavors or strategies, but they really all offer the same thing, is that you're investing in credit, which is protected from a downside, and you're getting a nice yield at the same time.
It's interesting. Even though interest rates have remained relatively high and you have seen so much money flood into riskier parts of the credit market, you are seeing that leverage loan demand coming back still. You're seeing companies come to market with new deals. How does that set up the private credit market here, which tends to compete with that leverage loan market as it puts money to work?
I think it depends upon which space. So a leverage loan market, those loans are typically much larger. They're called broadly syndicated loans for a reason. They're typically large and they often trade. Private credit, particularly the type of private credit and direct lending that we focus on, is typically focused on middle market businesses. So they're really not just right for the broadly syndicated loan market, because in one case you're looking for a $2 billion loan in the syndicated loan market. In the direct lending private credit market, you may be looking for a $200 million loan. So it's kind of apples and oranges.
What kind of returns can investors expect net of fees? You've been in alternative assets for decades now, and every American kind of knows what to expect from stocks, right? We've been raised to expect 5 to 10% average annual returns. It's now solidly 10 or 11, but what about private credit?
I think about it in terms of spreads, because it depends first where the base rate is. Many of these products are floating rate. So SOFR now is, call it 4.25%. Not that long ago, 4 years ago, the equivalent of SOFR, the predecessor LIBOR, was 0. So if you have a loan that prices at the floating rate plus, say, 500 basis points, 5 years ago, that would have returned 5%, maybe 6%. Today, it's returning closer to 10%. So I think about it in terms of what type of spread are you earning over a base rate.
Right, but if my mom is planning for her retirement and she doesn't know SOFR or LIBOR, right? She knows if I put my eggs in this basket, I can expect 10% returns. And if I'm in private equity or hedge funds, maybe 15% net of fees. What does it look like in private credit?
I think in today's world, and if you think about, again, private credit, it's a broad asset class. But if you just stick with direct lending, which is most of private credit, I would say a return in the high single digits on a net basis. Now, that necessarily won't compare to stocks, or certainly is not going to compare to private equity, but you have to look at the risk. Oftentimes, people invest in direct lending and private credit generally because you're investing in credit, which is inherently safer than investing in equity.
So is that 401k ready then? Ultimately, if you have a lot of retail investors that might put their retirement money towards this asset class, is it something safe enough, especially if you consider that people think about it as a completely illiquid form of money, but people pull from their retirement accounts?
I think it's safe. I'm obviously a huge believer, and I really believe it's just a matter of time before these types of assets find themselves in a 401k account. The key, and I can't emphasize it enough, is that the investor has to understand what they're buying. The investor has to understand that this is a credit product. It's not liquid. It's not like buying equities. There is an element of illiquidity to it, not nearly what it was years and years ago, but it doesn't trade like water. And I think as long as people understand that, and they understand it's a yield-oriented product as opposed to a total return product, I think there's a real place for it.
Which, by the way, Jeff, all of those things are actually perfect for a 401k, right? It's safer. You want to diversify. You're not trading in your 401k.
You're not looking for liquidity.
Yes, exactly.
You have it for the long term.
So one other question I have, too, is about the vintage 2025. People came into this year saying, well, wait a minute, the tariff pressure is looking a little bit like the COVID era pressure you saw in companies, not to the degree, but there was some pressure, and firms like yours were saying, okay, this might be another golden opportunity. Did that ever come?
I mean, I think it's here. People use the phrase golden age. I'm not sure. A golden age implies like, oh, everything is free. Everything is free. It's great. It's great. It's great. It's hard. What we do, investing in these types of assets, it's not easy. I think about it more in terms of what's happening. It's really a transformational moment or a transformational period. Is this shift of lending from traditional banks to non-banks is an enormous shift. It's not a cyclical thing. It's a real thing. It's going to stick around. And I really think it's just at the cusp. And if you look at what's happened in private credit generally, there are new strategies added all the time. So again, it started off as direct lending. Opportunistic credit is a big part of it. Asset-based finance, what Dan just talked about a few minutes ago, that's a big part of it. Real estate credit. So I just think it's going to continue to grow and grow.
It's Fed Day, so I have to ask you a rates question. And you know, obviously, to be good at your job, you have to have a good grasp of the economy. It's a big country. You deal with a lot of different industries and tranches. But what's your overall view of where we are right now in the U.S. and where we're headed?
I think the economy is in pretty good shape, not perfect shape, but pretty good shape. And in addition to our private credit business, we have a private equity business. So we actually have like a real-time laboratory. We don't have to call an economist as to what's happening. We can speak to the CEOs of our portfolio companies. And I would say, by and large, our CEOs feel pretty good. They're always cautious. They don't know what's going to happen out of Washington. What's the next move? They're not sure what's going to happen with tariffs. They think they have an understanding what's happening with taxes and fiscal policy. So I think they feel pretty good. You know, everyone uses the word uncertainty. I banish that word in our office because it's used all the time. It's unpredictable. It's unpredictable.
But do they say they're worried about inflation or we need rate cuts now?
You know, I've never asked that question directly to a CEO. Do you need a rate cut? Now, I'm sure that they would welcome a rate cut because as a private equity sponsor, our companies use leverage prudently, but we use it. And a lot of that is floating rate. And so if rates come down, that's a good thing. But I think our CEOs, by and large, feel that things are pretty good.
Jeff, we thank you for joining us here on set. Of course, a look under the hood in the world of private markets. That is Jeff Aronson of Centerbridge Partners. And Matt, we're coming closer to that moment. Do we see those descents or that Fed cut? And when do we see it exactly?
Yeah.
Do we get it as early as September? The markets are only pricing in a little over 60% of a chance of that right now.
Well, I'm going to be glued to my screen, the Bloomberg for sure, at 1:30 when Tom and John come on to preview that decision. Of course, it comes out at 2:30. We're going to get a ton of earnings reports after the bell. You got, as we said, Microsoft and Meta, but Ford, the Ford Motor Company, also reporting earnings. Investors looking for a guidance resumption as tariff unpredictability eases. And I'm actually going to sit down with the CEO of the Ford Motor Company, Jim Farley, joins us on the close today at 4:30. This is Open Interest. Shares in the Ford Motor Company edging lower in the early trade. Investors hoping the automaker will give a fresh update on how it's coping with President Trump's tariff regime. Bloomberg Autos reporter Keith Naughton joins us out of the Motor City to preview those results. Keith, what do we expect? What are the main headlines that you're watching for?
Well, we're looking for tariff impact and whether or not Ford will resume guidance. You might recall, Matt, they suspended guidance back in May because of uncertainty around President Trump's tariffs. Now investors would love to see that guidance returned, and they want to know how big a hit Ford has faced from tariffs so far. General Motors last week said they were impacted by $1.1 billion worth of tariff expense in the second quarter. Investors want to know about that with Ford.
It's interesting. It's unfortunately not the only set of expenses that they would be occurring. Do we know how close they are to being over with the recalls that they've been facing?
Yeah, they're on a record rate for recalls. They've done 90 so far this year. They're taking a $570 million charge in the quarter for a recall of almost 700,000 SUVs for a flaw that could cause engine fires. The recall thing has been a huge problem for Ford for years now. They're the most recalled automaker in America. So investors really want to hear how Farley is fixing that. They've often said they are improving, but so far it's not showing up in the numbers.
Keith, the tariffs and the earnings are clear. Any curveball questions you would throw to Jim Farley this afternoon, asking for a friend?
Well, I mean, there is still the electric vehicle strategy. Right, Matt? They lost $5.1 billion on EVs last year. They're still losing a lot. They have some new ones coming in a couple of years. But what do they do in the meantime? Electric vehicle sales for Ford fell by 31% in the second quarter.
Yeah, absolutely. As we wait for a next generation electric truck, as we wait for an electric three-row vehicle, and I'm not sure when we're going to get an update on that. Keith, thanks so much for joining us. Keith Naughton there in Detroit talking to us about Ford. Don't miss my interview with the CEO of the Ford Motor Company. Jim Farley joins us on the close at 4:30 New York time. By the way, you could also listen to and should if you care about cars, to my podcast, Hot Pursuit, with Hannah Elliott. She's a Bloomberg Pursuit's luxury reporter on the West Coast. So we talk more about the cars we love and the cars we want.
Well, the culture is half the battle when it comes to cars.
Yeah, I totally agree. And, you know, Ford, I mean, for example, they're going back to Le Mans next year, Ford versus Ferrari again. And they're going to be in F1. Like, there's a lot going on beyond just tariffs when it comes to cars.
There certainly is. But tonight, of course, we have earnings still coming up. We have that Fed meeting, of course, former Fed Vice Chair Richard Clarida, plus C-suite conversations with Robin Hood and Norwegian Cruise Lines. Stick with us through the close today, but tomorrow, more open interest.
Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, all eyes on tech earnings today. Meta and Microsoft, but also chip names. Qualcomm and ARM all reporting after the closing bell.
Plus, Palo Alto Networks buys CyberArk for about $25 billion in cash and stock. We'll discuss with the two companies.
And Anthropic's nearing a deal to raise as much as $5 billion, which would value the AI startup at $170 billion.
Meanwhile, let's talk about the public markets. Anthropic not on there yet, but we look at actually a little bit of risk-on attitude ahead of a huge day, Ed. You mentioned the earnings after the bell. We've also got the Fed decision that comes slap bang in the middle of the trading day. Scott Bessent, Treasury Secretary, saying he wants a little bit of imagination from the Fed. We're up 0.3%. Big tech managing to drive us forward. What are you looking at on the micro points?
Yeah, and usually I'm going to go to the private markets. Big story that Bloomberg broke in the last 24 hours. Anthropic raising $5 billion, $170 billion valuation. Later in the program, we'll get the details from Kate Clark, who broke that story. But it's a massive jump from the valuation earlier in the year. Earnings is everything right now. We get the first of the two Mag 7 names after the bell, two more tomorrow. But we're looking at capital expenditures. That's the clear story for both Meta and Microsoft. And then in the chip sector, you have ARM and you have Qualcomm. We're thinking smartphone, we're thinking laptop, and tariffs probably as well. My goodness, what an afternoon we're in for.
And we brace ourselves. Let's get more ahead of those big tech earnings. Meta, Microsoft, here to talk about what to expect. Bloomberg's Ran Vestelika. And look, the valuations are enormous for these companies. The expectations are high. What will we hear on capital expenditure, do you think? Is it going to rise?
I'd say that's the consensus right now, especially at Meta, which has been extremely aggressive in all of its AI plans. I'm sure you saw the story that Bloomberg had about the $200 million pay package for one AI engineer. A lot of acquisitions they've been doing, a lot of talent buying, and of course a lot of spending on data centers and AI and NVIDIA chips, so on and so forth. So I think especially there, people are expecting to see a lot of spending. And also at Microsoft, maybe a little bit less aggressive there, but certainly these are two of the biggest customers for NVIDIA, and they're also two of the biggest outperformers this year, at least among big tech. If there's any disconnect between that, that's going to be the real focus for tonight.
Ryan, I really appreciated how you and Felice sort of framed it in your story. Meta has capital expenditure growth of 100% year on year, probably. Microsoft 30%. But on the top line, you're going to get 15% growth and 14% growth, respectively. Where is it that the sell side are most focused? What is the metric that they're looking for? I think particularly in Microsoft's case as well.
Microsoft, the focus is, as usual, still going to be on the pace of Azure growth. That's its cloud computing business. People are also looking to see if they say anything about what kind of impact AI is having on sort of overall demand for Office, for with its Copilot product, things like that. That's going to be a real focus for them. I think people are growing more comfortable with just the level of AI spending so long as these companies can show that they are seeing a return on this. Last week, of course, we had Alphabet also increase its CapEx plans by quite a bit. People were okay with that because people feel like this stuff is going to pay off, especially over the longer term. They are really sort of developing a moat in terms of their AI businesses. So far, we haven't seen too much caution, but like you said, expectations are getting higher and higher. The stocks have been doing extremely well this year. It wouldn't necessarily be surprising if we did see a pullback on these news.
Ran Vestelika is going to be all over those numbers when they break after the bell. Let's now turn to our first guest, Uday Chiruvaru. He's a portfolio manager at Harding Loevner, a $55 billion asset manager. You have Microsoft, you have Meta on your global strategy. Among them, an easy question, or maybe a simple question. We'll see how hard it is to answer. Is it vindicated, this capital expenditure increase?
Look, the capital and expenditure increase is bigger than what we've seen